Welcome back to Investing Talk Podcast.
Today we're looking at global partners. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Global Partners just dropped its Q3 2025 earnings. November 7th they came out. And, well, the market reaction was a bit mixed, maybe scratching its head. Because the results, they were really a tale of two stories.
They really were, yeah. If you just kind of glanced at the headlines, you might have been a bit worried. Net income landed at $29.0 million. That's, a pretty big step down from $45.9 million the year before.
Right. And on top of that, the earnings per unit, 0.66 cents, it completely missed what analysts were expecting, which was more like 0.85.
And revenue was lighter than expected, too.
Yeah, revenue missed as well. So that net income figure, that's the first thing we need to sort of unpack. It seems like it was mainly driven by these margin headwinds, as they call them, the fuel distribution part of the business.
Margin headwinds, basically getting squeezed, right? Costs go up, but they can't just hike prices at the pump instantly.
Exactly. Competition keeps prices in check, so profits get squeezed. That's the headwind.
So, okay, the accounting profit doesn't look great because of those pressures, but, and this is important, we need to look beyond that. Look at the cash the business is actually generating.
Precisely. Because despite that dip in net income, operationally, the company showed, well, impressive strength in generating cash. Adjusted EBITDA, always a good measure for operational health, was strong. $98.8 million.
Okay.
And crucially, distributable cash flow, DCF, that came in at $53.3 million.
And that DCF number, for a structure like this, that's really the key figure, isn't it?
It absolutely is. It tells you the underlying operations, the scale, the execution.
Yeah.
It's solid.
Like the engine's running smoothly, even if the road's a bit bumpy right now with fuel prices all over the place.
Well put. The key takeaway here is that their wholesale side seems strong, good margins there, and fuel volumes held up surprisingly well. That's helping to offset the squeeze in the gasoline distribution part. This isn't, a business falling apart.
No, sounds more like it's navigating a tricky market using its size and operational know-how.
Exactly.
Okay, so given that cash flow generation seems pretty consistent, let's talk about the main attraction for many investors here, the distribution, the payout.
Absolutely. For a lot of people looking at this company, it's purely about the yield. And that cash flow story we just talked about, it supports management's ability to keep paying, maybe even growing it.
And they did grow it slightly. They announced a Q3 distribution, 0.755 cents per unit, just a tiny bump from Q2's $0.7500, but still. That pattern of consistent increases, even small ones, sends a strong signal.
It really does. Speaks volumes about confidence, especially with the volatility we saw in the net income number. And that stability is why the yield looks so juicy right now. What is it? 7.11% currently, based on the $3 annual payout.
Yeah, 7.11%. Now look, a yield that high, it often makes people nervous, right? Like the market might be thinking there's a big risk the payout could get cut. What makes us think this one's actually secure?
That's a fair question. You always have to ask that with high yields. The security, I think, comes down to the balance sheet. When you dig into the numbers, assets are around $378 million. Liability is about $310 million.
Okay, so what does that translate to in terms of dividend safety?
It means they have a decent equity cushion. The debt seems manageable, especially considering their operating size. It doesn't look like a company that's, stretching itself thin just to maintain that distribution.
So the DCF covers the payout, and the balance sheet provides a safety net underneath.
That's the idea. And for an income investor, that combination is pretty critical. Makes the high yield feel a bit more comfortable.
Right. Makes sense. But you can't just be a dividend machine forever. You need some growth, some kind of forward-looking story, especially when, let's face it, the traditional fuel distribution market isn't exactly booming long-term. How are they tackling that?
Yeah, they definitely know that. They're not just sitting back. They seem to recognize that future growth, future margins, it's not just coming from the gas pump. It's increasingly coming from inside the convenience store. That's a higher margin retail game.
Okay. So this is where the strategy gets interesting. They're really pushing the retail side. We need to look past just fuel sales.
Yes, exactly.
Yeah.
Look at their operational footprint expansion. They're rolling out new retail brands, like Honey Farms Market.
Yeah.
This isn't just slapping a new sign up. It seems like a real effort to boost the quality and, importantly, the margin of stuff people buy besides gas.
And the loyalty platform, right? Bees Knees Benefits.
Yes, the Bees Knees Benefits platform. That, to me, is the real kicker for making customers stick around.
Loyalty programs are huge these days.
They're crucial, not just for driving repeat visits, but think about the data they generate. That data lets them personalize offers, manage inventory better, push those higher margin items, basically turning a quick gas stop into maybe a regular coffee stop or lunch stop.
So they're kind of morphing into a retail company that also sells fuel?
That seems to be the direction, yeah.
Okay, so if someone's thinking about investing now, what should they be watching over the next, say, 3 months to see if this retail push is working? Any key catalysts coming up?
Good question. The big one, most immediate, is the Q4 2025 earnings call. That should be around January 8th, 2026. That report won't just be about Q4 numbers. It'll give the first real outlook for 2026.
And people will be listening closely for any commentary on those gasoline margins stabilizing.
Exactly. Our margins recovering. What's the forecast? That'll be key.
And then there are the market-wide things, right? Like year-end rebalancing.
Yep, always got to watch for that. Year-end ETF index rebalancing around December 31st. That can definitely cause some short-term noise, volatility.
Yeah.
Funds buying or selling to match indexes can create dips or pops.
Opportunities, maybe? And then after the new year, we get the institutional filings.
Right, late January, early February usually. The 13F filings window. That's when the big players, hedge funds, big asset managers, have to show what they bought and sold.
Seeing if the big money is moving in or out. That can be a powerful signal for short-term sentiment.
Definitely. And one more data point. We should get the holiday fuel and convenience sales report late in December. That gives us a first peek at how those retail efforts did during the big shopping season.
Okay, interesting. Now, what about the rumors, the speculative stuff? I keep hearing whispers about potential bolt-on M&A. What does that mean in this context?
Yeah, those rumors fit right into the retail strategy we were talking about. Bolt-on M&A just means buying smaller companies or assets that easily slot into their current business. Think like maybe acquiring a small chain of convenience stores they can quickly rebrand as honey farms.
So enhancing the core, not buying something totally different.
Exactly. And then there's a longer-term speculation. Unconfirmed talk about potential joint ventures in like renewable fuels or biofuel distribution.
Ah, now that's looking further ahead, towards the energy transition.
Right. That's probably the most, let's say, exciting speculative catalyst. It would really beef up their growth story, showing they're thinking beyond gasoline for their distribution network. Future-proofing, basically.
Okay, makes sense. Let's shift gears hard now. Away from fundamentals and catalysts, let's talk about the stock price itself, the technicals. Where is Global Partners trading now?
Well, the stock's been under pressure. It's trading near the bottom of its 52-week range, around $44.51 last I checked. The low for the year was $39.70, so it's not far off that. But importantly, it's sitting just above a key technical support level, around $43.20.
Support levels are often where buyers step in, or at least where the selling pauses. What are the momentum indicators saying, despite the price drop?
Actually, they're showing some potential signs of life, suggesting maybe a rebound is possible. We're seeing some bullish signals. The MPD indicator, for example, that's giving a buy signal. Basically means short-term momentum might be turning up. And there's talk of something called a golden star signal, which hints that maybe buyers are quietly accumulating shares down here. Suggests a possible medium-term reversal.
But we have to be realistic. These are just hints of a bounce. The stock's been in a clear downtrend since, what, April 2025?
That's the reality, yes. A clear long-term downtrend is still in place. These technical signals suggest a possible bounce off support, but they don't automatically break that bigger trend.
So it would need a real catalyst, like those strong earnings or an M&A deal we talked about, to really change the narrative and break that downward momentum.
Precisely. Needs confirmation. Although Wall Street seems pretty optimistic longer term.
Yeah, the analyst consensus price target, where's that sitting?
Average target is $56, which from current levels implies, wow, like 32.7% upside potential.
So analysts clearly believe the underlying business, the cash flow, the retail strategy, that it'll eventually win out over the current headwinds.
Seems that way. But of course, no investment case is complete without looking hard at the risks.
Right. We mentioned the big one already. Those gasoline margins staying compressed, or fuel volumes fluctuating. That earnings volatility is the main company-specific risk.
Definitely. And you can't ignore the external stuff either, those persistent rumors about potentially tighter emission standards, whether federal or regional.
Yeah, that's a longer-term headache. Could mean unexpected costs for upgrades, and it threatens those traditional fuel volumes down the road.
Serious strategic issue to keep an eye on.
Okay, so let's try and pull this all together. We've got resilient cash flow, that very attractive high yield, this interesting retail growth strategy.
But also a slumping stock price, technically,
Yeah.
real margin pressures, and some regulatory uncertainty.
Yeah.
How do we synthesize all that? What's the final thesis?
Well, looking at the balance, the overall investment case seems pretty solid, actually, especially because that high dividend yield provides a nice cushion, kind of tilts the risk reward in your favor while you wait.
So our overall rating, weighing everything, it leans bullish. Let's say an 8.5 out of 10. The core appeal is really that secure high yield, plus the potential for a technical bounce off that support level around $43. And then the longer-term upside, if those retail initiatives like honey farms really start firing.
Okay, 8.5 out of 10, bullish. So who is this stock best suited for right now? What kind of investor?
I think it appeals to two main groups. First, your classic yield-focused investor, someone looking to buy and hold long-term for those stable, hopefully growing, payouts backed by the DCF.
Makes sense. And the second group?
Maybe more opportunistic swing traders, people looking for that potential 1 to 3 month pop based on Q4 earnings may be surprising, or those retail catalysts starting to show results and triggering that technical reversal we talked about.
Right, so income play or shorter-term catalyst play.
Yeah, it covers both bases potentially.
Okay, that's a good summary. Before we wrap up, any final thought for listeners to chew on? What really stands out here is how heavily Global Partners seems to be banking on these new retail brands in a loyalty program, Honey Farms and Bee's Knees. They're using them to fight back against those undeniable headwinds in the traditional fuel business. The real question, the one investors need to ask themselves, is how quickly can that retail strategy actually translate into stronger, more stable margins as we head into 2026? That feels like the key variable.